Spring may be just about in the air, and as we prepare to say goodbye to February and hello to March, we've around 20 members of the FTSE 100 primed and ready to report figures or provide a trading update in the week ahead. They include Primark owner Associated British Foods and Bunzl on Monday the 26th of February, Bid Target GKN, Insurer Direct Line and Standard Chartered Bank on the 27th, another insurer Admiral as well as ITV and Tesco on the 28th, media giant WPP on Thursday the 1st of March, and London Stock Exchange and Packaging and Paper Player Monday on Friday the 2nd of March. But for me, the one name really capable of causing a fuss is housebuilder Persimmon, which is due to report its fourth quarter and full year results on Tuesday the 27th of February. And by the way, Pierre Taylor Wimpey reports the following day, the 28th. With a gain of over 20% in the past 12 months, Persimmon's the 20th best performer in the FTSE 100 over that time span. And as we can see here, the fourth best performer of the big 9 house builders who sit within the FTSE 100 and FTSE 250. It's pretty good going, although the chart here shows the shares have lost momentum quite badly over the last few months. And this weakness may reflect a number of factors, most notably the first interest rate increase from the Bank of England in a decade last November, concerns over how house price inflation continues to outstrip wage growth, and soggy consumer confidence, although this did show some improvement in January. All of which is combining potentially to mean that UK mortgage approvals fell 9% year on year in December to just over 61,000, the lowest figure since January 2015, as we can see here. Perhaps not surprisingly given that figure, house price growth has begun to cool a little bit as well, as we can see from the graphic showing data provided by the Halifax. All of this makes the timing of the Persimmon full year numbers particularly interesting. Now, January's trading statement flagged a 9% increase in revenues as completions rose by 6% and prices by 4% for the whole of 2017. The FTSE 100 firm also flagged a 10% jump in forward sales and a £1.3 billion cash pile. That means a key number to watch in the full year 2017 numbers is pre-tax profit, and analysts are looking for £965 million against £775 million a year ago. The really important stuff will come in the outlook, the forward-looking stuff, and any guidance we get on completions, where we can see the trend over the last 10 years and we're still below 2006 levels. Prices, where we can also look back 10 years. Persimmon's average of £213,300 is the lowest of all the big quoted builders, mainly as a result of its geographic mix. It sells more in the north than it does in the south. And again, any guidance on pre-tax income. Here, the consensus analyst forecast is for a 6% increase to just over £1 billion for 2018, and watch for any comments on the interplay between pricing and cost pressures. That leaves one final big number, the dividend. Remember, Persimmon's deep into a huge cash return programme, where it intends to return £1.10 a share to shareholders each July until 2021, and it even provided an extra 25p on top of that in March last year. That 110p a share annual payment equates to a dividend yield of 4.5%. Add on the extra 25 pence to 135, and that yield becomes 5.6, with earnings cover of 1.9 times compared to a FTSE 100 average of 1.7. That's why some analysts are now homing in on the builders as yield plays. But if you agree with that income thesis, you need to still ask 3 questions. What could happen if there's a housing downturn, unlikely as it seems at the moment, in terms of profits and therefore dividend cover? In the event of a deep downturn, Persimmon probably could hold those dividends by using up its massive cash pile rather than by buying land. But buying land cheaply is what makes builders tick in the long run. So that could be a big strategic call if push came to shove. Would management stick with the dividend and sacrifice land buying? And finally, what chance is there of a housing downturn at all? A forward price earnings ratio of barely 10 suggests the market's still frightened of one, maybe in a post-Brexit world. So let's see what Persimmon has to say when it reports next week. Thank you for watching, and I look forward to seeing you next time.